Hello my peeps, what is up? I'm Samuel, and today let's start by rewinding the clock. Before I started working at Grow, before I started this project, before I started learning about this industry. So here's your history lesson. September 7th, 2017, 1 year ago today, one of the largest credit reporting agencies in the country reported that 143 trillion million people had personal information like their social security number, credit card info, addresses, and things like that compromised due to a data breach. And so in response to all of the madness surrounding that situation, that same company then decided to offer a free of charge product that allowed people to monitor their credit and hopefully give a little bit of sense of security during this time. So I love free things and I'm a sensible dude, so I enrolled. And so now let's fast forward to March 2018. Just a month after I started working here at Grow, I had an alert pop up that something was wrongfully being connected to me and affecting my credit score. Now the credit score is something I'd always generally been cognizant of, but there was a lot I didn't know and I was really worried about the negative implications of something like this being attributed to me. So realizing that I had a ton of resources here in my new job, I talked to some friends I made early on, and they gave me not only great advice in the situation I was currently in, but also a greater understanding of what my credit score is made up of and how to have more control of it moving forward. All right, so 3 things out the gate. What's a credit score? Let's take a look. Yeah, that's what I thought. A credit score is basically just a number that an individual is given to indicate how capable they are to pay off a loan or manage their debt. All right, second, how's it measured? The scale actually goes from 300 to 850. Why they couldn't make it a 10-point scale is a great question, but alas, 300 to 850 it is. And the last big chunk is what's the composition of the number you end up with? So it breaks down into 5 categories. All right, so number 1, payment history. This is the simplest and it's the largest. It accounts for 35% of your score. And it's calculated exactly how it sounds based on whether or not you've paid your bills on time. So if you have a credit card, make your monthly payment on time. If you have a mortgage, make your monthly payment on time. If you have a kite rental business loan, make your monthly payment on time. It's not rocket surgery, guys. Pay your bills on time. All right, 2, credit utilization. This accounts for 30% of your score, and it just comes down to how much of your available credit you're actually using. So if I have a $1,000 credit card limit, and at the end of the month, I have a $500 balance, I've used 50% of my available credit. And generally speaking, the lower the percentage, the better, because you're not spending on the maximum amount of the money lent to you. All right, number 3, length of history. I'm not gonna dive too deep into this one because I'm assuming you guys have a rough concept of how time works, but this 15% is based off of the average amount of time your credit lines have been established, and the longer, the better. Number 4, credit mix or type of credit. So this is 10% of your score, and I had it explained to me this way. No one likes a salad with only lettuce. Pause. I don't like salads at all. I'm gonna start over, but every time I say salad, I'm actually gonna replace it with pizza. Pizza is my jam. No one likes pizza with only lettuce. You want all that other stuff in there like croutons, dressing, tomatoes, all that other stuff to make your pizza tastier. So the same thing is true with your credit. If you only have one type, it just doesn't instill the same amount of confidence in potential lenders because you haven't shown that you're able to manage different types. Now I want pizza. Okay, so number 5 and the last 10% is credit inquiries. And the important thing to draw out here is there's actually 2 different ways that a company or person can pull your credit. There's hard and there's soft. The hard pull, that's the one that affects your credit. And it happens when you apply for a credit card, maybe a new car loan, maybe you're getting a new apartment, those sort of things, and you have to give them consent to do that because they have to be able to make a decision based on your credit history on whether or not you're going to be approved for whatever you're trying to do. And so the thing to be careful of or aware of here is that too many of these hard pulls in a short amount of time can be a red flag to lenders and have an impact on your score. So there it is, the 5 things that affect your credit score: payment history, credit utilization, length of history, credit mix, and credit inquiries. There is a ton of information in this video. If there's something you want to see covered a little more in depth, please comment below. Don't forget to subscribe and take And like the video if you're walking away with a better understanding of what credit scores are, and if you're excited it's Friday. I'm pretty pumped. Peace out.